Good afternoon. Thank you for joining us for today's webinar, 2024 by the Numbers and What's Ahead. My name is Sean O'Brien, the president of QuickRate, and am pleased to be joined today by both David Ruffin, who's the principal for IntelliCredit, and Dan Marks, who is the president of Infusion Marketing. So the three of us are going to tag team and kind of do a baton race here, handing off and focusing on three different sections. We're going to cover the normal lineup of things. We'll touch first on the QCBI results. David will talk about credit and the outlook. We'll look at Dan will focus on just kind of what they're seeing in consumer deposit trends in the campaigns that they're running for banks at Infusion, and then we'll just give you a few updates of what's new here at QuickRate and IntelliCredit. As always, we'll go ahead and get started with some polling questions. Just a couple of reminders before we do this. We will receive a copy of today's slide deck in a follow-up email tomorrow or first thing Monday morning. Secondly, certainly use the chat feature and the Q&A feature to submit questions throughout. We'll monitor those and take those at an appropriate break in the conversation, or certainly at the end of the presentation today. Oops. All right, so let me just get started with the polling questions. Certainly, again, appreciate as always jumping in and just giving responses for these. The first one, we got 5 today. They're all pretty short and straightforward, but the first one's just, beginning of the year, are you budgeting for higher or lower earnings in 2025? So just a single choice, higher, lower, or about the same. And we'll just give this 30 to 45 seconds and then move on to the next one. Share these results. 48% higher, 34% about the same, and 17% lower. So appreciate the responses. Let's go to the next question, just regarding concerns as we look into 2025. What concerns you the most as you prepare for 2025? Again, a single choice: cost of deposits, attracting deposits, credit quality, margin compression, lack of loan growth, or other. You again, we'll share these results. So attracting deposits is number one on the list, and then kind of evenly split amongst cost of deposits, credit quality, margin, and lack of loan growth. So again, thank you very much. The next question is regarding deposit growth. What are you estimating for deposit growth this year? Less than 0%, 0.1 to 2.5, 2.5 to 5, 5 to 10, or greater than 10. So we try to just line these up around the ranges we use in the QCBI as the reason for a little bit of an unusual categorization of them. Okay. Most everybody's kind of in between 0 and 5%. So that's, again, interesting to see. Again, I think for all of us, I know at the little community bank where I'm a director, I know this is really top of mind. We feel like loan growth is going to be decent this year, but attracting deposits is continually the challenge. So let's stop sharing this one. Just a couple more. Now to loan growth. What are you estimating for loan growth this year? Again, just same buckets. Okay. Good to see 2.5 to 5%, 5 to 10%. So that's encouraging. Obviously creates a little bit of a deposit, a delta, if you will, shortage. So again, just, kind of reemphasizing the need for us to all be able to attract deposits this year. So our final question is regarding the reserve. Do you expect your reserve to increase, decrease, or roughly stay the same in 2025? So you again, we'll share these. 49% think it'll stay the same. 46% will see an increase or expect to see an increase, and 5% a decrease. So fantastic. Again, we will share these results from the polling questions in our email. And again, thank you for participating with us on those today. All right, so let's, again, just each quarter I've just kind of continually, showed what kind of percentage of uninsured deposits, are at each, at the banks across the country. I do this more so just as a reminder, consistently we're here, still hearing in exams that examiners, want to make sure you can, cover those uninsured balances with wholesale funding or other funding options. So we just want to kind of keep that up and mindful. Same way with just the underwater securities. They had been improving going into the third quarter, and then we kind of took a step back, as the year closed. This is, again, a little bit of a repeat slide just because, again, I think for most of us in the community bank world, right, we're focused on deposits. I think, increasingly we have to recognize that while we are in search of new deposits, our existing customers, are also targets from other institutions or fintechs. And so, again, I think as we think about our own retail strategy about trying to acquire, we also need to make sure we're being protective and defensive of our best customers, those who have, wallet share that, can add meaningful deposits to your institution today. Dan, if you attended his webinar last week, he and Tim talked about, customers and prospects who have both the capacity, meaning they have available deposits, and the propensity and the inclination to work with you. A couple of it, kind of themes that you'll probably continue to hear both from us at Quick Rate and certainly from Dan and the Infusion team about just, again, trying to gain more wallet share from customers. As the polling question indicated, deposits remain kind of the top priority. I think for most anecdotally, stories we've heard, the start of the year, I think banks feel pretty good about the outlook for the loans. I think it now becomes, filling that bucket with deposits and, more importantly, deposits that fit so we can kind of defend our net interest margin. So, always a priority. But I think, again, in high focus as we start 2025. Of course, we know, not only trying to obtain deposits, but pricing them and loans are critical to success. If we think back to 2024, the high-performing banks, were one of the most correlating components of high performance last year was the ability with regard to loan pricing. There was a strong correlation to the high performers, both in pricing loans and deposits this year. Marketing then thus continues to be a central focus. Certainly traditional and digital methods. Again, I referenced the 7 winning deposit campaigns that Dan did a webinar on last week. If you didn't attend that, certainly we can get you a copy of it. But I think you just reiterated some of the mindsets and disciplines in just trying to continually be out in front of your customers, trying to attract deposits. Efficiencies, I think, again, are always highly correlative to success and high performance. That's increasingly important for community banks. So again, I think if loan demand is slow, it's even more where we're doubling down to try to make sure we're being as efficient as we can possibly be. As we move into the QCBI numbers, kind of what we have seen again, is last year just kind of ended up being a little bit more of the same. We didn't really spike in really down or low. It was just kind of a continuation of what we saw in 2023. You can see asset growth, 28% of the banks didn't have any asset growth. But the 1 to 10 billion, community banks, certainly of any of the bank sizes saw the highest asset growth. Loan growth, again, positive, but not what it had been the last couple of years. And again, I think, anecdotally, we're hearing people are feeling better about this year. So hopefully we'll see a little bit of a rebound in that. Certainly impacted by, the lack of mortgage originations. Yeah, just a little bit more tepid loan growth over the last 12 months as compared to the previous couple of years. Deposit growth, though, we did finally see an uptick. So that's certainly, was encouraging. Again, pricing on those deposits in many cases was expensive, but at least we stopped some of the erosion that a lot of banks felt, in 2023 and the early part of 2024. Again, somewhat concerning that, 26% of the community banks in the country didn't see any deposit growth. Another 15% only saw 0 to 2.5%. And as you look at the deposit growth by asset size, right, the lowest growth median is for the banks who are 0 to $100 million. So again, making it much more difficult for those smaller institutions. Everybody else, the median values, seem decent given what the growth was. Performance-wise, as I touched on earlier, yield on loans went up. Pricing of particularly commercial credits last year was very, highly correlative for bank performance. But I think kind of across the board, we saw good, loan pricing for community banks. The flip side of it was those, loans were funded with deposits that were much more expensive than what they had been in the previous couple of years. A 65 basis point increase at the median. And then again, you can kind of see, the $1 to $10 billion banks, the median cost is almost, 244. So certainly, the larger institutions were willing to pay up more than what some of the smaller institutions, were willing to do or could afford to do. So again, something certainly we'll monitor as we go forward. And again, hopefully be able to share whatever we learn as we go throughout the year. NIM, we held pretty tight, just down a basis point at the median. Again, on a positive note, the 0 to $100 million banks, usually this table's kind of been flipped where the bigger banks usually have it, but here when it comes to margin, it's kind of reversed. The smaller banks are defending their margin as effectively as they possibly can, which is good to see. In terms of non-interest income, again, kind of 3 straight years of roughly the same kind of median value. But here again, you can see the larger the bank you are, the more likely it is that you are pulling in, a fair amount of non-interest income compared to the smaller banks in the country. Finally, on efficiencies, they've continued to tick up here the last 3 years. So, I think, whether it's this presentation or anyone you're really, listening to anymore, a lot of it's, involves technology, trying to be more efficient, trying to, manage our culture to be able to deploy as much technology as we can to make ourselves more efficient. Clearly much easier to do the larger the institution you are, but you can see, start to see here at the median at nearly 75% on the efficiency ratio. Certainly much more challenging for the smallest of community banks in the country. Finally, for ROA and core operating earnings and ROE, really 4 straight years of declines, still hanging above 1% ROA, which is encouraging to see. Core operating earnings the same way is just kind of trended down. So again, not the trend we want to see. Hopefully, this is a year where we start to reverse those. And then when we look at ROA and ROE again, you can see the median ROA at 84 bips, median ROAE, return on average equity, just slightly in the median at 9%. And then again, to the right here, when you start looking at these by asset size, 6% median, 6.29 median ROAE for the smaller community banks, everybody under 10%, which, hopefully we'll start to get back to double digits as we move through 2025. Finally, just this last slide just kind of gives you a little bit more breadth and spectrum from the median. Again, we are focused on median values, but we know, some are, more interested in kind of seeing what the spectrum of percentiles are. So this just kind of shows it to you. I think for particular note for me, when I was looking at this compared to last year, right, we see non-performing assets, trending up over the year, particularly at the 90th percentile there at 160. It was 131 last year. The median last year was 27 basis points for non-performers. This year at 34 basis points. The reserve actually ticked down 4 basis points at the median. But again, I think as one of the earlier polling questions regarding the reserve, I think most people expect the reserve to be the same or higher this year, and I think that kind of is in lockstep with what we're seeing is just a kind of a continual slow rise in non-performers. So certainly something that I know David's going to talk about, but we'll continue to monitor in these presentations as we move through the year. So at this point, I will turn it over to David, and he's going to talk to you about the credit landscape.
Okay, so hopefully you will see. Let's see, let me get these.
Yeah, you just had to just move it back, I think, a few slides, David.
Yeah, there we go. So let me go to the beginning. Sorry. Hopefully you can see that.
Yes.
Okay, good. So yes, I'm going to play a bit of. There was some sense of brighter days ahead at the beginning that Sean said. I could detect some of that movement in the polling. I'm going to play a bit of the role of the credit guy here, so bear with me. There's no question that there's been some elation in the industry generally over three particular, maybe four things. Rates were reducing, although the Fed has recently indicated they may be putting a pause on that. Inflation certainly was showing some improvement, but again, for the reason the Fed took the position recently is that there seems to be some persistent concerns about inflation. And I will say this, that certainly inflation is very agnostic to where it comes from, whether it's large government funding or whether it's from tariffs or whatever direction it's coming from. It really doesn't really show any bias to that. So we have to keep an eye on that. And I think there was one, I don't think there's any question that the most singular impactful aspect of credit quality and maybe even the election results was inflation. The last 2 or 3 years. Certainly the election results has given the industry in many cases a sense that particularly regulatory relief was in the offing. We saw that very dramatically just last week with the CFPB and aspects of that. I might add, just from my perspective, I think the largest aspect of regulatory relief under the new administration is going to come under compliance or through compliance as opposed to safety and soundness. There's a lot of, I think, embedded reason that not taking the energy out of the gauging of where we are from a credit risk standpoint or from a banking risk standpoint is not necessarily going to be the focus of some of the regulatory relief. I will say, and this is based on, from attending 4 large conferences in the last, just since the first of the year. There seems to be a bifurcation, frankly, between the euphoria at the C-suite level and the lenders. Lenders are seeing some of the stress points that are beginning to creep into production. Sean just alluded to some of that, and I do think that we have to be sensitive to it. But I'm a credit guy, and I believe in, we're so dominated by our Wall Street kind of financial press that's kind of quarter by quarter, what have you done for me lately? Credit is a long game. I just published an article through Bank Director that talked about the need to look at credit from more of a long game perspective. Lest you think I'm all about the traditional credit guy in the black hat, embedded in that article was there's some real opportunities, I think, going forward, even into 2025. For example, there's kind of a bipartisan sense that with the passage of the Infrastructure Act and the CHIPS Act, that may lay the groundwork for some really strong economic growth in the next 2 or 3 years in terms of the investment of what that actually means. We've also got the development of what I call private credit providers that have arguably, frankly, taken some of the risk out of traditional banking, and they should be looked at, frankly, as conduits for some, in other words, an avoidance of taking some highly risky, highly levered deals and highly specialized lending. And not only that, I think we have to give credit to the kind of post Dodd-Frank era, which created some risk protocols that differentiate us as an industry from where we were 15 or 20 years ago before the Great Recession. But again, let's pivot back to some of the issues, because I think those of us in the banking world or in the financial industry have to keep an eye on risk, and particularly credit risk. That's the big elephant in the room. The metrics remain very good, generally speaking, certainly the public metrics, but there are some signs of concern that I'd like to talk about. Certainly, the rate and inflation shocks, as I alluded to, have taken some toll on borrowers, particularly some of you have heard me use this term before, the paycheck to paycheck consumer. Just yesterday, it was announced that credit card balances had reached record $1.2 trillion. And I do think that is even businesses depend at some point directly or indirectly on consumers to fund their growth and their revenue. There is clear evidence, as I alluded to, that the lender sentiment is a little it seems to be growing in terms of credit quality. We've certainly seen in our loan review work in the last several months the largest number of downgrades, frankly, in years. Most of them are in the pass categories, into low pass, not so much into the criticized classified yet, but we all know, those of us in the credit risk world know that early detection within those pass risk categories is really a corollary for preventing sizable losses if we do enter into heightened credit stress. There is no question that the regulatory scrutiny has been turned up in the last year, and as far as we can see at this point, particularly on the safety and soundness issue, continues. Credit process appears to be the primary focus, not so much transactional credit degradation, but those of us, even in the loan review business, frankly, are getting scrutinized around what is the quality of the loan review being provided to your financial institution. There is no question we've moved into now almost universal expectation for more stress testing, irrespective of the asset size of the financial institution, and the flavor of the era at this point seems to be pretty much heavily on loan level stress testing. We think that the combination of what our sister company Quick Analytics does with portfolio level is an excellent way to do peer compare, but we have now the loan level stress testing that gives you a deep dive into your unique DNA of your loan portfolio. There is clearly, though, one of the biggest concerns that I continue to have is what I am terming here some segment obsolescence in CRE. Teleconferencing, digital shopping, remote work has perhaps forever changed the paradigm of real estate use that we have to accept. Smaller banks, as we know, and smaller institutions have frankly loaded up with a lot of CRE exposure in the last 20 years. But again, I want to remember or restate, we live on Wall Street, not Main Street, or excuse me, we live on Main Street, not Wall Street, and this is a longer game for us. It doesn't change on a dime quarter to quarter. So you say, David, we've heard you say this for 2 or 3 periods of these quarterly reports that CRE is concerning to you. This is based not empirically on exact data or on explicit information, other than a really an aggregation of what we glean from our extensive loan review work, our M&A. We just finished an M&A deal the last week or so. As I said, I've attended 30 plus conferences in the last 12 months. I listen very clearly to experts that get up and talk about this. I listen to regulatory commentary. Just 2 days ago, I was hearing an economist from the Federal Reserve saying, it's now, do not think this is just a false red flag. CRE stress is growing. And we look at proxies, what I call proxies, as from the bond market and the REIT market into some troubling information that's coming out of those markets. For example, the CMBS market is showing the highest stress levels in years and years. Apartments are leading some of that. Office has been there for a while. But little telltale signs of things like the overdependence of mezzanine debt to just keep debt service coverage in an acceptable range are telltale signs of, I think, growing stress in the commercial real estate market. I've again taken this as my opinion, not scientific necessarily, but uh, one to four family housing, ironically, unlike the last financial crisis, is not the centerpiece of our concern as much. Um, Owner-occupied CRE, some could argue that's more like a C&I credit delivery. The data centers are on fire for obvious reasons with AI and the cloud explosion. They are healthcare due to the aging of our population, and some of the smaller retail seems to be reasonably healthy at this point. Again, the heightened stress seems to be coming with frankly, the most trajectory of concern of late is multifamily or apartments. They've got a lot of issues going on with that. The paycheck to paycheck consumer are the prototypical renters in apartments. Many of these apartments are very high end. As I said, the operating cost of these are going up with insurance and so forth. They're basically locked into how they can't push their rents up, but so much higher. And in some markets, even dynamic markets, there's indication of overbuilding at this point. Office has been there for a while. Hospitality is beginning to show exactly what was predicted post-pandemic, and that was business travel is off because, frankly, corporate America sees how to save a lot of expenses by not having mid-tier employees travel to events. And much of hospitality depends, not unlike the airline industry, on business travel, not consumer or vacationing travel. Farmland has shown significant deterioration of late, and we all know agriculture tends to be one of the most kind of roller coaster industries in our lending sphere. They go from very strong, and again, tariffs, we have to be accepting that tariffs sent the ag portfolios into a lot of stress about 2017. If that's repeated, we got to accept that might be another headwind for them. Warehouse industrial was very strong 2 years ago. That has shown some strong weakness. Larger retail, we understand the big box entities are really suffering from digitized shopping and so forth. But even as you go into certain local areas, locales, it's something that never occurred to me. I was in California a few months back on a conference, and they're concerned with vineyards and the value of vineyards because demographically, a lot of people under 30 years old aren't drinking wine anymore, things of that nature. We're now forced into the credit world of understanding what is the supply and demand dynamic going on in not only all the markets, but all the industries that we're lending into. It's that added dimension beyond just the classic credit analysis component. So again, this is not scientific. It's not coming from the regulator per se, but it is an aggregation of inputs that I hear from regulators, industry experts, and certainly our work extensively in the loan review work. So let's go, in this case, go back to where we ended 2024. This is somewhat an add-on to the deposit discussion that Sean left. This is the trajectory of wholesale deposits by region. And these, again, are QCBI banks under $10 billion because most of our clientele are in that realm. And if I threw in mega data in this, it would skew the message here. But in this case, as you see, the Northeast is leading the dependence on wholesale. And there's a little story in a minute I'll show you about that. But it is tapering off. As Sean indicated, we've had some reasonably good deposit growth, somewhat tepid, but at least some growth from the past couple of years. Not uncommon, as a corollary, you'll have gross loans to deposits. You also have, in this case, the Northeast leading that. So you've got they're averaging 90% loan to deposit in the Northeast region. The Southwest was the least dependent on wholesale funding, but also predictably has the lowest loan to deposit because they seem to have a bevy of deposits in the Southwest banks that some of the other regions don't seem to be enjoying. These charts I show each time, and as you can see here, there is an uptick in non-performing loans. So the inventory of our credit problems are beginning to increase, as Sean indicated a moment ago. Charge-offs are clearly showing some upward trajectory. But this is the case there. On the right is the more traditional way we account for reserves in banks, and that shows that we've got some increase in inventory problems, but we're generally speaking, for the smaller institutions, a decline in reserves. Again, the Northeast, with 90% loan to deposit, is a good bit well below the national average in terms of their reserves. And, they're under 100 bips for reserves. And I'm speaking from my experience here, I guess. It's very difficult for me to hear regulators get comfortable, no matter what the reserve methodology is, CECL or what have you, if banks are under 100 basis points for reserves, it's just going to put, I think, more obligation on the bank to defend that. Again, this is my favorite depiction of reserves. It's really the reserves to your ratio reserves to your inventory. As you can see, again, smaller financial institutions, the arc has been to continue in the last 2 years to decline in reserves. The larger banks have increased reserves the last 2 years, largely because of fear of the CRE problems. Community banks have declined, although that's, I think, as Sean said in your polling showed, that you expect that to turn around a bit this year. But again, compare that to particularly the CRE concerns that I've just shared, and that is large banks and all other credit providers in our economy have begun to shed CRE exposure. Even it has finally shown in the CRE with smaller financial institutions that is beginning to take hold in that sense as well, but still on a proportionate basis, more dependence on CRE. Again, you see here the construction, loan, and development. You would naturally see the Sun Belt and the Southwest and the Southeast to lead in that. That's the subset, the 100% guidance on construction and development. You would expect more dynamic markets that have demographic, both in migration and job creation, to lead in that. And then you've got the CRE broader 300% guidance. Again, but as I said before, the last 2 quarters, it's not about these 100, 300. It's really more the subsets. How are you defending your concentration and your lending in the subsets of these CRE categories? As I've already alluded to, multifamily apartments is my biggest concern because there's a lot of even participations. There's a lot of exposure in the marketplace on those. C&I, again, is since the PPP era has returned to its normal level at smaller institutions. And of course, as you would expect, the Midwest would lead in agricultural and farmland. Again, these are not Farm Credit System numbers. I'd like to close this segment with something that many of you have heard me say before. I think the 3 most important aspects of risk management in the particularly once you've made the loan would be stress testing, which is, again, a lot of the smaller institutions are getting acclimated to that. We certainly offer that in 2 formats, one that can be done companion with a loan review, the other a more sophisticated modeling based on probabilities of default, loss given defaults. Both of them, however, take it out of the theoretical and leave you with a sense of, if we get into this level of stress, here are the top 15, the top 25 credits that you do need to be keeping an eye on. The other is, of course, portfolio analytics. Smaller institutions still lag a bit behind the larger ones in terms of understanding and using their own loan data, which is, as I said earlier, your DNA, to your benefit to understand and create early detection monitoring, and that gives you that ability. We certainly offer that at IntelliCredit with our portfolio analyzer. And then finally, loan review. I think that's very, very important to, in this particular point in time, to be sure you treat your loan review, whoever does it, and in whatever form it's done, in an independent arm's length fashion, as your partner, because you want that level of early detection to be in place. We're big on using only seasoned reviewers, but we also employ and couple that with very efficient technology that frankly gives the engagement a less intrusive nature. And we're agnostic to the use of that because we license a number of banks where they do internal loan review themselves. They don't depend on that. And we have other vendors even that use our application to do that. So again, remember these: stress testing, portfolio analytics, and loan review. They're going to be your strong partners, I think, in terms of not only fending off some growing credit risk, but also making sure you can say, we know we're captain of our own ship. We understand what we're managing from a credit standpoint. Dan, I'm going to hand it over to you, sir.
Awesome. Thanks, David. Good stuff. So the third leg of the stool that Sean laid out is just what's happening in customers, and with deposits, of course, being the first among equals in that realm for all the reasons that he shared. Infusion's perspective is informed by the work we do all over the country. So over 27 states, hundreds of community-focused FIs like is on this phone call. And then one of the things that we are really honored by is the results we've been able to achieve with our clients as they're looking to achieve specific growth goals, whether or not that's deposit growth, margin improvement, remixing a portfolio, driving lower cost of funds, or even very targeted, granular, high quality loan growth or fee income. And so we constantly track at a specific level, but then also keep track at a global. And so we're over 21 billion in balances generated with our clients that all tie back to specific tactics and specific tracking. And then it's undergirded by billions of reference points that help us understand opportunity and then also monetize that opportunity through targeted tactics. And that reference point there's really two parts of that. The big picture norm database, and so we call this the Infusion norm, but there's product and relational insight that from over 50 million households. And you think about the sample in the US, that's a very robust sample. So tons of behavior information all across the balance sheet. So it's the intersection of deposit usage, transactor usage, and borrowing, all in how do they make decisions? What's the overlap? How do we migrate customers, whether or not the consumer or business, towards a full relationship, full share of wallet? So there's the macro picture. Then equally as important is our campaign norm database. And so this is made up of millions of records where we've executed campaigns and analyzed them, or in cases worked with clients to analyze campaigns they may be running on their own. And so it's the combination of those insights of macro and then specific targeted activities that allow us to uniquely help you understand what's happening, what could happen, and then actually go turn that potential into money, balances on the balance sheet, fee income on the income statement. And so just some pieces of each one of those databases. When we look at what's happening on the customer level for checking, probably not surprising, we continue to see moderation in the average household checking balance. And this does vary by segment, varies by business model a little bit, but just macro picture, as rates have stayed relatively elevated. I mean, even if they've come down a little bit, they're still elevated versus where they were 2 years ago. And so you see money moving out of the low cost deposits into yield seeking. And so one measure of that is on the right hand side is just we've seen a tick up. We've seen the return of interest checking. So even in the last 18 months, the household penetration of interest checking has gone up almost 300 basis points when you look at the 23.7% penetration compared to the 26.4, the most recent period. And so that's even within checking, people are seeking yield because there is yield to seek. And people do behave in kind of rational ways. But there's still really low, still checking has all the benefits of low cost funds, stickiness, relationship primacy, and then a huge nexus of fee income as part of the foundation of someone's operating or transacted relationship. Other couple of trends. So looking at CDs, as people have seeked yield, we're seeing a continued rise in the average household balance, and this is household balance of households that use CDs, right? So it's by definition, it's a group that has capacity to do deposits. But we've seen continued march upward in terms of the average balances of those using, but then also continued march upward of the penetration. So in the last 2 years, the penetration has increased almost 50%, going from a near-term low of 7.4% up well above 10% and still climbing. So shows consumer demand for CDs. Now, obviously, that's the highest cost deposits usually in the customer balance sheet, and so you want to be mindful of there's that demand. Don't want to overpay for it, but if we don't proactively speak to current customers about things that are relevant to their needs, like CDs, we risk losing them to competitors. So going back to the comment about how do we defend and grow relationships, being proactive and offering things that meet their needs. Now the good news is we constantly find in the deposit webinar that Sean mentioned it provides some unpacking of this. But when you apply data and a holistic approach to be very, very specific, you're able to sell based on matching up need and that capacity propensity, and so you don't have to sell on rate. And so that's one of the levers that even while meeting this need, we're helping clients drive volume at a moderate cost. Money market, kind of unsurprisingly, is fairly elevated. We are seeing kind of the average household balance fairly steady. So in the 80s, even actually a little bit lower, as rates have started to drop. That's certainly people are looking for. That's fueling one of the CD rise, but the penetration continues to steadily move upward, approaching 200 basis points higher in terms of household penetration for the money market product. So again, people are looking for yield. They're looking for, in this case, fairly easy access to money at an acceptable yield. And so, being mindful that this product fills a related but different need on that continuum of products is really important to think about. How do we meet customer needs while also managing margin? So we talked about household penetration. We also look at average response rate. And so this is booked account response rate, meaning I targeted the household for a particular product and looked at the ratio of that household response by opening an account. So this is going past any kind of click or any kind of step on the funnel like a lead. This is actually going to what is the tactic drive and actually converted booked accounts. And you see really a moderation in CD response rates, still fairly healthy. I mean, if we were to rewind the clock even further, that 4.4% average response rate in Q4 is still about twice what we would have seen pre-2020. And then money market high yield savings had a little bit of a it's been more steady, so it certainly had a rise as rates started rising, but it's closer to that kind of long-term average in the 2% change. So the key takeaway here is there is demand to be harvested when you're very thoughtful and driving kind of rifle shot aim and messaging and being controlled with what you're doing. We're also I'll touch on briefly what's happening in customer behavior on loans because probably not unsurprisingly the average balance of households using loans continues to climb even while the average penetration rate tends to be a little bit more moderate. And this is kind of across the board, again, across business models and size of institutions. So kind of the takeaway there is high quality customer growth to be had, but you have to be very selective and targeted. And then credit card. So this is a little bit of a tale of two cities. We see dramatically higher demand on penetration on credit cards among credit unions than banks. Now, some of that reflects banks tend to be more outsourced credit card, but pretty steady penetration of changes of credit card. And then finally, consumer loan campaign responses. Similar patterns between credit unions and banks. Banks tend to be a little bit less responsive, but see twice the average balances. So again, there is quality loan growth available that can help enhance relationship aspects. And we see there's an overall relationship flywheel dynamic that as bankers meet specific customer needs and methodically get a base hit every day, meeting those needs, it builds loyalty, stickiness, and helps them be that much more responsive to whatever is our highest priority at that time. So that's a real quick tour on what's happening, both from a macro customer perspective, focus on deposits, and in campaign. So I think we're going back to you, Sean.
Thank you, Dan. Yeah, let me just take back the screen here real quick. Okay. So again, thanks to Dan and Dave for their presentations today. Again, this will be the format that we continue to kind of go with for the remainder of the year. So again, just really trying to touch on all the important aspects, right? What we're seeing in consumer activity for deposits and loans, what David's seen in credit, and then just the overall performance of the community bank space. I think again, just a reminder, I did post in the chat if you are interested in your state version or in the state version of our QCBI. There's a link in there that you can request the state QCBI. You can also, for any Quick Analytics subscriber, you can pull that down as well. I think again, just anecdotally, I think most bankers are optimistic about this year, particularly around their margins and their earnings. They do feel like 25 will be a better year than 24. As David indicated, though, we still have to remain vigilant in managing our credits. Right, it's something that clearly still can go awry for us. Past dues have been rising. Nothing that rises to the level of immediate concern for a lot of institutions, but I think we again anecdotally, as David touched on, what we're hearing and seeing in exams, more scrutiny, more higher expectations around credit administration, and so making sure you have the tools and your teams kind of aware of that as you move forward through this year is certainly important. And then Dan touched on, and then we just touched on at the beginning, the fight for deposits is always there, but it's probably each year gets increasingly difficult, right? There's more people coming from them. you know, a lot more technology, a lot more different methods for coming after your best customers. But also for those of us, you know, it can be restrictive on our own institution's growth. So, you know, I think, you know, one of the lessons that, you know, even myself, listening to Dan's presentations, you know, as we've been doing them here over the past 5 or 6 months, right, is just really changing the mindset in our institutions that you got to hit a base hit every day. You got to go out there and just have the discipline to continually fight for the deposits, because you know, that's certainly what others are doing, and so we have to be ready to you know, to address that and respond to that as well. Just a reminder, you know, tomorrow we have a CECL presentation, but for those of you who aren't familiar with all we do, Quick Rate, IntelliCredit, and Quick Analytics, and now certainly for some you know, Infusion marketing services as well. So most of you have seen this slide before on IntelliCredit. As David mentioned, we can assist you with you know, third-party loan review, as he also indicated, and increasingly has come up in conversations, is the ability for us to prepare a loan level stress test for you in, you know, in conjunction or as a complement to the portfolio level test we have in Quick Analytics. And then certainly our portfolio analytical tool, again, continues to see real positive response and reviews from our customers. To that end, we continue to offer a 3-month trial. We recognize that it takes some time to get up and, you know, really to use the tool. It's pretty easy to get the data in there, but we want to make sure that you can see all the benefits that you can receive from utilizing the tool prior to having to sign up for a subscription. A couple of events that you know, webinars that are coming up. March 20th, we'll be doing a webinar on liquidity. March 21st, Dan and Tim will be back with a lead generation presentation. Oops. You know, hopefully, you know, again, new customer acquisition. So a discussion around lead generation that attracts new relationships. So certainly encourage you to register for both of those webinars. When you register, you will receive always receive a link to the recording and a copy of the slides. Finally, tomorrow, we're back with our first coffee talk for this year for CECL. And then in April, Paul Allen will join us for that installment of our coffee talk. Let's see. Yeah, you're not seeing my, oh boy, let's see. Let's make sure my slides didn't move. I apologize. That my slide deck wasn't moving with me. I apologize to everyone for that. Thank you, Dan. So let me just go back through these a couple of slides here. You know, our upcoming events around liquidity and the lead generation, March 20th and 21st. So certainly register for those. And as I mentioned, the coffee talks with Steve Huntington and myself tomorrow, and then Paul Allen will join us in April. Certainly any past webinars are available on our YouTube channel or on the website. And I don't see any additional questions at this point. Certainly, if you have any, go ahead and submit those now. But certainly, thank you for your time today. Thanks to Dan and David for joining us on the presentation. Certainly reach out to us with any questions at info@quickrate.com. And they certainly will welcome any opportunity to give you a tour on any of our products or services. So don't hesitate to reach out. Dan or David, any final comments or thoughts before we let everybody get back to their day?
Yeah, organic, quality, moderately priced deposits are there. Yeah, there for the taking.
Yep, and I think
that is good to hear.
And I think for whatever movement on stress there is, I think there are tools available to keep the bankers and the credit unions ahead of that concern.
Fantastic. Again, thank you all for joining us today. Appreciate you making time for us, and we'll look forward to seeing you again next quarter. And again, anytime in between, just reach out to us, and we'd love to chat. Thanks so much, and have a great day.